All right, let's talk about investing. If you've ever felt like it's just way too complicated or maybe a little overwhelming, then this is for you. Today, we're going to demystify one of the most powerful tools out there for any investor, the investment fund. You know that feeling, right? The idea of trying to pick the next big winning stock. For a lot of us, it feels less like investing and more like a trip to the casino. You hear these amazing stories, but you also know it's incredibly risky and, let's be honest, requires a ton of research. That fear is real, and it keeps a lot of people from even getting started.
But here's a wild idea. What if you could bypass that whole high-stakes stock-picking game entirely? What if you could take a single dollar and with that $1 instantly own a tiny little piece of over 3,000 different companies? I know, it sounds kind of impossible, but it's the real concept that makes investing accessible for absolutely everyone.
So, what's the secret? Well, the solution to this whole stock-picking headache is something called an investment fund. It's actually a beautifully simple idea that solves the biggest hurdles for new investors, things like risk and complexity. So let's break down exactly how it works using a really simple analogy. Okay, imagine you're at a vending machine with just $2. You can only buy one snack. If you pick one and it turns out to be terrible, well, you've wasted all your money. That's a pretty big risk for a snack. But what if you and, say, 3 friends all chip in your $2? Now you've got $8. You can buy 4 different snacks. Chips, cookies, candy, the whole shebang. Even if the cookies are awful, hey, you've still got 3 other great snacks to share. You see, you've pooled your money to spread out the risk. And believe it or not, that is exactly what an investment fund is. It's just a giant pool of money collected from thousands, sometimes millions of different investors. All that money is then used to buy a huge, diverse portfolio of assets. We're talking hundreds or thousands of different stocks, bonds, you name it. You're no longer betting everything on one snack. You're getting a little taste of the entire vending machine. Okay, so now you get the basic idea. But here's the thing. Not all funds are created equal. Fund is a pretty broad category, and they come in a few key flavors. Let's walk through the 4 main types you're probably going to hear about, just so you can really understand your options. Now, before we dive into the types, you have got to understand this one crucial difference, active versus passive management. An actively managed fund has a professional manager, a real person or a team who's trying to be a star stock picker. They're constantly researching, buying, and selling, all with the goal of beating the market. On the other hand, a passively managed fund, well, it does the opposite. It just automatically buys all the stocks on a preset list like the S&P 500 and holds them. It's not trying to beat the market, it's just trying to be the market. And this difference is everything. First up, the classics, mutual funds. Think of these as the old-school, traditional way to do it. Most of them are actively managed, so you're paying for that professional's expertise. A key thing to know is that you can only buy or sell them once a day, after the market closes. They also can have pretty high minimums to get started, sometimes hundreds or even thousands of dollars. And yeah, their fees tend to be higher to pay for all that active management. All right, next up are index funds, and these are really the poster child for passive investing. So an S&P 500 index fund, for example, doesn't have some genius manager making brilliant trades. Nope, it just mechanically buys shares in all 500 companies that are on the S&P 500 list. And because there's no expensive star manager to pay, the fees are dramatically lower. Index funds are really a philosophy. Just own the whole market and grow with it. Then we've got ETFs, which stands for Exchange-Traded Funds. Now, these are super popular, and for good reason. They kind of combine features from the other types. They are funds, so you get all that great diversification, but they trade on a stock exchange just like a single stock, like Apple or Tesla. That means you can buy or sell them anytime the market is open. Most ETFs are passive index funds, and they usually have rock-bottom fees and little to no minimum investment, which makes them incredibly friendly for beginners. And finally, let's just quickly touch on hedge funds. You've probably heard about these in movies, right? Think of them as the super exclusive VIP room of the investment world. They are only for very wealthy, experienced investors with minimums that can easily start at $100,000 and go into the millions. They use really aggressive and complex strategies to try and get huge returns. For pretty much all of us, this is a world you'll only read about.
Okay, that was a lot. So let's just put it all side by side so you can see the big picture. When it comes to management, mutual funds and hedge funds are usually active. Index funds and ETFs are passive. For trading, ETFs give you that anytime access, while mutual funds are just once a day. And of course, the minimum investment is a huge difference, from maybe a single dollar for an ETF to millions for a hedge fund.
So that's the what. Now for the really important part, the how. With all these options sitting in front of you, how in the world do you decide which path makes the most sense for you? Well, it really just comes down to a couple of key things.
First thing to think about is just convenience and flexibility. With ETFs, you have high flexibility. You can trade them all day long, react to the market in real time if you want. Mutual funds, on the other hand, offer low flexibility. You put your order in and it just happens at whatever the price is at the end of the day. Neither one is better, it just depends on your style. Do you want that minute-to-minute control, or are you more of a set-it-and-forget-it kind of person? Next up, and honestly this might be the most important part of this whole conversation, is fees. The annual fee, it's called an expense ratio, on a typical active mutual fund can be 10 times higher than the fee on a passive index fund or ETF. Now that might not sound like much, but that 1% versus 0.1% is taken out of your investment every single year. Over decades, that tiny difference can eat up a massive chunk of your potential returns.
Which of course leads us to the big multi-trillion-dollar question. You're paying that higher fee for the active manager's expertise, right? The whole promise is that their skill is going to lead to better returns that more than make up for their fee. So, does it work? Do the expensive star managers actually beat the simple, cheap index fund?
And the answer, well, it surprises most people. It's actually pretty counterintuitive. Decades of data have shown pretty conclusively that the vast majority of actively managed funds fail to beat their passive index counterparts over the long term. That's right, the simple, automated, low-cost approach usually wins.
So why? Why does this happen? Well, it boils down to a few simple truths. First, consistently picking winning stocks to beat the entire market is just incredibly difficult, even for the pros. Second, like we just saw, those higher fees act like a constant drag on performance that the manager has to overcome just to break even with the index. So the key takeaway is, passive funds aren't trying to be heroes. They just aim to capture the slow, steady growth of the overall market, and they do it very cheaply. Okay, we have covered a ton of ground here, so let's boil all of this down into a final, super clear takeaway that you can actually use as you start your own investment journey.
So let's just walk through the path we just took, one last time. We started with the problem. Picking individual stocks is really hard and super risky. We found the solution, investment funds, which let you buy hundreds or thousands of assets all at once. From there, we saw the key choice you have to make is between active funds with high fees and passive funds with low fees. And finally, the big insight. The data shows that for most of us, that simple, low-cost, passive approach often leads to better results in the long run.
Look, understanding funds isn't about finding some kind of magic bullet. It's about understanding the map of the investment world. And now, you have that map. You know the different territories, you know the main paths you can take, so the only question left is, where are you going to start exploring?